I think my approach to investing has changed quite a bit in the 16 or 17 months I've been involved. Not the publicly traded companies, obviously, in that analysis, but on the private front, sure. You learn throughout the entire experience what matters, what doesn't, how to give different weightings to different things. But unfortunately, one of the things you learn is there's no formula, that you have to bring a different set of tools and a different set of thinking patterns to each and every due diligence process. So it's been interesting. It's a lot more time consuming than I imagined it would be. It really is. To get to know the supply chain, the distribution alternatives, all those types of things for 31 different deals in a year, you better be setting aside a lot of time. You know, it's interesting, we get asked a lot about exit strategies. And a lot of investors, angel investors in particular, are quite demanding on that front. They want to know how they're going to gain access to liquidity down the road. I'm the opposite. I would much rather invest in a firm that had no exit strategy, that was in there for the passion and that thought they were trying to build something of value for the long term. I think you're more likely, interestingly, to get an offer to sell if you don't pursue one. If you set out trying to create against something of lasting value that you want to be involved with forever, those are the types of companies that draw the outside interest. If you design a company with the intention of selling it 3, 4, 5 years down the road, the likelihood of that happening goes down. So I'm not a guy who pushes exit strategy at all. I'm more interested in how we're going to develop a sustainable business with a good, solid bottom line.